market will be up around double digit, around 10, 11% year end. That's what most of the consensus is. Some of that's based on multiple expansion to 24 or so, but nobody's bearish. If you look at what the
Yeah.
streets
I
come
mean,
out, consensus, the street, nobody's bearish. Nobody's calling for a
and
down market,
that's
which
that's part of what concerns me. I mean, if you put a
yeah,
23 multiple on, 23 multiple, which is not cheap, on next year's earnings estimates, which are 310, you're talking about 7130, for the S&P,
mm-hmm,
and we're about 6,900
yep,
today. It, it's
yep,
it's just not a lot of upside. I mean, my banks, in a perfect world, could go up another 10%, and I'm guessing that they will into the first quarter. But I don't know what, do I want to play for that last 10%? I mean, they're not cheap, so it's very difficult to know what to do at the margin. I mean, there's certain things I
yeah.
own that I'm letting run, and that's easy to do. But to you know buy incrementally here, it's getting tougher.
Yeah. I mean, I'm still bullish on energy. The thing with energy is, could oil prices go down a little bit further? Yes. But you've got most of the bear case baked in here, other than if oil were to go to a four handle, which I don't think it does. But everybody knows that forecasts are for an oversupply situation next year. Oil's down here around $57 a barrel, and the stocks are holding up. And I think the reason is everybody's trying to look through that and say, look, the worst case scenario or close to it seems to be baked in here.
Yeah, that's the one area where I am very overweighted is energy. But you're right. I mean, people are expecting Venezuela to come on stream. That's not going to happen anytime soon. They're expecting
That
No,
won't
peace
happen
in
anytime
Russia.
soon at all.
no,
Yeah,
that's
and
one
then they're
thing.
expecting
One thing I want to talk
peace
about
in
this morning.
Russia.
Venezuela.
Yeah, they're
Yeah,
expecting peace in Russia, which means the sanctions can come off. So there's all sorts of those kinds of things that are going into people's decisions right now. But you know, I'm not sure that you want to put a big bet on those things. But I don't know. And geopolitics is clearly. I mean, you know more about this, Bob, than any of us, but it's playing a role in how things
yeah.
are setting
It's
up.
playing a role when you have gold and silver trading like this. All right, let's rock and roll. Let's get this show on the road, boys. All right, this is Wall Street Beats. It is December 22nd. We're getting close to Christmas here. And we have Charlie Peabody and Bob Morris joining me today. I don't know what that noise is, but and I'm Benjamin Bryant. Let's start out with you, Charlie.
All right. So I'm going to talk. We were saying as we were opening up the show that I'm not really sure what to do at this point. Markets are not cheap. I mean, if you got $310 of earnings on the S&P next year, and you put a 23 multiple, which is not a cheap multiple, you're talking about 7130 as your upside. That's we're at 6,900 today, so it's not a whole lot of upside. If I look at the area that I know fairly well, look at the bank stocks, maybe there's 10% upside. So you can let your winners run here, but it's hard to find stocks that you want to own incrementally. The areas that I've been going into have been sort of deep cyclicals on the whole theme that this is going to be a run hot economy. So I've been looking at chemical companies, packaging companies, staffing companies, things like that. Now, banks obviously are also a play on cyclical run hot economy, which is what Trump wants. But here's the deal. The bank stocks year to date, which is pretty much the whole year, are up about 31%. The S&P is up about 16%. So we've had substantial, in earnings this year are maybe up high single digits, low double digits at best. So we've had a significant amount of multiple expansion already baked into these bank stocks. Most of that has come here in the fourth quarter. I mean, just in the fourth quarter alone, my group of bank stocks are up 9% and the S&P is up 2%. So it's, what the banks are anticipating is one, a run hot economy, and that's going to drive net interest income. And that is being reflected in a steeper yield curve. And so that's something we started writing about in the summer. We expected a steeper yield curve, a bear steepener, if you will. And we thought that would accrue to the benefit of the regional banks because they're highly dependent on net interest income, which expands off of that, wider yield curve or steeper yield curve. So the regional banks have had a phenomenal catch up relative to the money centers, which have been the best performers year to date. So here are the dynamics. Going into the first quarter, if you're a money center investor, this is what you're anticipating in the huge multiple expansion that they've enjoyed this year. You're anticipating a robust capital market cycle. M&A and equity are now driving the cycle more than fixed income. That usually happens at the mature phase of the cycle. Typically, M&A volumes peak at around 4 to 5% of GDP, or 5 to 6% of world cap market capitalization. In the third quarter, we had about 1.3 trillion of worldwide M&A activity. If you annualize that, that's coming to the lower end of those measures that I just gave you, those parameters. So the capital market cycle is moving from fixed income to M&A and equity. M&A is reaching its historical peaks at 4 to 6% of GDP or market capitalization. So yeah, we're going to have another great first half in 26 for investment banking and trading, but it's starting to be anticipated in the multiples. So the next thing that the bank stocks are anticipating is deregulation. We're going to get further capital relief in the first half of the year. We're hoping to see, some finalization of the Basel III, endgame capital rules, and some relief on the GSIB capital requirements. And that should, allow banks to have, more excess capital and buy back stock, which they're buying back 4 to 6% of their stock. So those are very positive elements. But again, I think it's, highly anticipated. And then the third thing that, the investor is, and this is the final thing that investors are anticipating, and that is, a continued benign credit environment. And yet, you're starting to see some continued, deterioration in the C&I loan portfolios. So there are risks, but there are also huge positives. So you got a steeper yield curve, you got a robust, which helps NII. You got a robust capital markets environment, but close to its peak. You got deregulation, which is going to allow buybacks, which is very anticipated, and you get benign credit. So the setup going into the new year is very, very positive for banks. The problem is, they're trading at 2, 3, over 3 times tangible book, which by any historical measure is very expensive. On a PE basis, they're trading at about 12 times, next year's earnings, and about 55% of the market multiple. That looks relatively, cheap on a historical basis. They can trade, at 14 or 15 times. And so that's what you have to hope for, is that the earnings outlook remains benign or positive, I should say. That none of the things that I mentioned get disrupted. In other words, we don't get, further scares on the credit front, that the M&A cycle continues to be, a virtuous one where more M&A leads to more financing, leads to more, IPOs and et cetera. So yeah, I'm going to let some of my, money center wins run, like Citigroup. That's been a phenomenal stock for me this year. The incremental buy that I've had on the regional banks has been US Bancorp. That literally has been one of the best top 2 performers in the fourth quarter, USB. The other one I like is Flagstar, FLG, and that's a play on the possibility that commercial real estate has bottomed. And that FLG's Flagstar Bank is trading around 13, and tangible book is around 18, and I think it can trade a tangible book. So those are the 3 names I would go with if you want to buy them. And I'll leave it there, Ben. See if anyone has any questions.
Hey,
All right.
Charlie, quick question.
That's
On the
that's a
curve
nice
steeping
little.
side of your argument, no, I was going to ask you on the curve steeping side of your argument, given the strong GDP number we got this morning, if for an additional interest rate cut doesn't come till, say, even May at the end of Powell's term, is that on the margin a negative for the banks in not having that curve steepen as much if that next rate cut is pushed out several months?
Yeah, I mean, we've got what, 68, almost 70 basis points of curve steepening between, the 2 and 10 year as of yesterday anyway. And that's so, and that's up from like 45, 50, back in the third quarter. So we've had some steep curve steepening already, which is, they're benefiting from, and you're getting a pickup in loan demand. So I don't think, a pause in the rate cutting cycle is going to hurt them. It may not, create
Okay.
another incremental headwind, but it's not going to hurt them.
Okay.
Yeah, I mean today's actually flattening a bit, to be honest. Yeah, all right,
I
Charlie.
didn't
Well,
see
you let me know when
where tens
I
and
can make
twos.
money shorting. You can let me know when I can make money shorting J.P. Morgan. I look back at 2025 and wish I never tangoed with that thing. That was not a fun experience. While watching the private equity guys get spanked and the BDCs get spanked, and I'm just screwing around with J.P. Morgan, the king, if you will. All right. Well, let's move over to
Yeah, I
Bob.
mean,
Bob,
it
what's
is the
going on
best
in the
franchise. It
patch?
is the
Are
best
we ever
balance
going to
sheet.
have any?
Is the,
Yeah, they're the best. I agree. Like they're the best. I get it. Don't mess with the king.
but Ben, by the same token, one of the things we
So
pointed out is
Connected. Bob, tell
they're
us
going to
about
grow
oil and
expenses
energy.
next year by 9%. Even in a run hot economy, it's going to be hard to grow revenues double digits. Um,
Okay.
it
All right.
looks
All
like we
right.
have a
I think we
delayed
had a little.
feedback.
Yeah, I think we got a little lag there. Bob, go off on energy here. I think we have a little communication issue.
yeah, so talking about oil prices, oil's down here close to $58 a barrel, and you look at the drivers here still near term. We got a much better than expected GDP number here this morning, which on the one hand is sort of causing some people to think that maybe that next interest rate cut is paused here. But the positive is that's a strong economy, a stronger than expected economy should be good for oil demand. At the same time, you look at Venezuela, and the headlines this morning are that the Trump administration is looking at seizing a third oil tanker out of Venezuela. In near term, you could argue that that's again supportive for oil prices in that you're taking that oil off the market. Trump has said, well, we don't know what we're going to do with the oil. We're going to keep it. Maybe we'll put it into the Strategic Petroleum Reserve. Maybe we'll sell it. But that oil is effectively near term out of the market as it's just sort of sitting there on the water in the hands of the U.S. as the Trump administration looks to continue to seize these oil tankers and shut down the export of crude oil, which is a lot on these ghost ships and underneath the auspices of the sanctions that are going on there. So we would argue that near term, those two factors should be positive or supportive for the oil price. And the one thing though, when you look at the Venezuelan crude oil, well over half of that oil, which they're exporting less than 1 million barrels a day, but over half of that goes to China. And Ben, as you know, I've talked, China continues to build their strategic petroleum reserve at a pace of close to 1 million barrels a day. So that oil from Venezuela that was going to China, they just pause filling their SPR and not go out and try and buy other crude oil around the globe to continue that pace of strategic petroleum reserve fill in China, or what happens. So you don't know if that gets displaced or not, or what ultimately happens there. But longer term, this should be positive. And this is longer term because clearly the Trump administration wants regime change in Venezuela. Part of the number one argument is shutting down the flow of fentanyl to the U.S. But I also think there's an energy aspect to this that they want to continue to bring down energy prices. And one way is to get more Venezuelan crude oil into the market, which longer term, like I said, Venezuela is exporting less than 1 million barrels a day. At the turn of the century, they were exporting 3 million barrels per day. They have huge proven reserves. It's just that the infrastructure is being held together by duct tape down there. And under the current regime there, they just can't expand or get that oil flow back up to what it should be. So if the current administration is able to affect some regime change and get new money or infrastructure in place there, longer term, that's a lot more oil that could come into the market. And as you and I've talked about before, Ben, is that Chevron's the big beneficiary. They're already there. They're already operating there, but they've already got a foothold that if that does occur, that transition occurs, Chevron is the big beneficiary long term. And as you know, Chevron's one of our overweight holdings in the energy sector. The other factor here is Russia and Ukraine. And how that plays out, we don't know, but the latest headlines are that they're closer than ever to some sort of peace deal, which then would be negative for oil prices, and that lifting the sanctions on Russian crude oil exports would put more Russian crude into the market. So we're sort of at this, balance of sort of watching what's going on with economic growth, both in the U.S. and China, watching what's going on with the crude oil from Venezuela, whether more crude oil gets into the market if there's a peace deal. So I think oil prices, they continue to be low in volatility. That forward curve continues to be somewhat flat. And I think we still stay here close to $60 a barrel. The good news is that the energy stocks arguably have held up very well here. I mean, the better names have held up very well. You look at Chevron, CNQ, a lot of the gas names, they're up year to date, not like the market, not 16% or anything like that. But as we were talking pre-show, I think the market is already largely baked in a lot of the bad news or this lower oil price, as the market often does. And as we've talked about on previous shows, some of the contrarian plays is that some of these oil service names have been picking up and being bought. The energy names are holding up here. And so I'm still constructive on select energy names that we do own. In particular, I'm holding on to my gas-focused names, Expand and EQT, still very positive on those, although winter weather is the biggest variable in how those play out into 2026. But I'm still positive on energy and oil prices here, or at least the energy stocks and the valuations, even at oil at close to the levels where it is today. But I think you look out longer term, even though the forward curve is somewhat flat, I think longer term oil prices will go higher. And even at $60 a barrel, though, I think the stocks are cheap and good value. So I'm sticking with those better names. I'm not adding to anything today. I'm not selling anything today. One thing I mentioned last week, I've continued to incrementally nibble at Valero as a refiner, although I'm still way underweight on that name. But I've been adding to that name as on any pullbacks or dips, just trying to ultimately build a bigger position there.
Cool.
Hey, Bob. Like on the gas names, because you mentioned you're still long EQT and Expand Energy, they've taken a bigger hit than the oil names in terms of the recent correction. And I'm just curious, you mentioned the weather, and obviously that probably is a factor, but wasn't there some report that Citadel had gone huge long gas and it didn't work out? And I don't know, but I'm wondering, are they ones that are putting pressure on the gas names? Are they unwinding some of their positions, or do you know anything about that, Citadel?
I'm not sure. I mean, you hear rumors, but it's hard to tell whether that's what's weighing on the market. I think the bigger factor was some of this warmer weather that crept in here and taking natural gas from $5 to $4. As you said, of late, very recently, yeah, they pulled back because they had such a huge run. I'm looking at Expand Energy had run from 95 to what was it, almost 119 in 2 months, less than 2 months. Equitable had a huge run. So even though they pulled back more recently, they'd have had a huge run into the winter on the initial cold weather that we had. And so, as far as El Nino and how the whole winter plays out, we'll see how that does. But they're still up big year to date. I don't know what Expand. Yeah, I mean it's up slightly, not 16%, but it is up year to date. But as far as Citadel and winding a position, I really don't have any insight on that.
And my second question was related to, last show we talked about oil on the water, with two now, maybe three tankers and from Venezuela being confiscated. Is that oil off the market now, or can Trump somehow reintroduce that oil into the marketplace?
Yeah, and that's what I was mentioning earlier. Is he said they're going to keep the oil. He doesn't know if they're going to put it in the Strategic Petroleum Reserve, or if they're going to sell it, or what they're going to do with it. At this point, I don't know. I'm just guessing, but at $58 oil, I would go ahead and put it into the SPR. If I wanted to really push oil even lower, I'd sell it. But nobody's complaining about prices at the pump. They're down. That's one thing that the current administration's been highlighting. We'll see what they do. He said he doesn't know. He said, look, we may put in the SPR, we may sell it, we'll see. But But I would imagine if they're winning on the energy cost side of the equation right now, I would put it in the SPR. But at the same time, they could just go out and sell it and use it as a tool to try and continue to pressure oil prices down.
I mean, you know, the
Okay.
Trump
And I have one
administration clearly
little
has
tidbit.
failed on their.
I'm sorry. Go ahead, Ben.
Oh no, I think I was just gonna say one little tidbit. I shorted the Carvana again on Friday or Thursday at 465. They were included in the S&P 500. I like these S&P inclusion trades. You know, guys run these things up right to the S&P inclusion. They beg hold the passive holders. Me and Charlie feel about the same about Carvana in general. I don't need to go into what my like underlying feelings is about that. But I think there was a gaming that went on where the stock went from 290 to 475 from November 20th right into that S&P inclusion, and it's off 10% already. I think that thing might have that you looked at Lululemon, you looked at Tesla years ago. Often these S&P inclusions are the highs for some of these stocks, where guys on the street will run this game of S&P inclusion being the way to offload their supply. And Charlie, you have any thoughts on the Carvana these days, other than that it's
I
just
actually
absolutely ripped on?
Yeah, no, I actually presented on the auto industry the last time I was on the show, so a week ago. And if you look at the 26 forecast, all red arrows for new cars, used sale cars, CPOs, in other words, certified pre-owned cars, lease sales, everything is red in terms of, and not red from 17, 18 million units, which is a nice sales unit. It's red from a 16 million. I think we will do 15, point 0.9, maybe 16 million units this year in terms of sales. So it's red from a pretty low base. So it's a year and a half ago, I had this theme: anything that needed to be financed would disappoint. But I did not include cars in that theme. It was houses, it was Winnebago, RVs, it was, a motorsport, snowmobiles, it was boats. And that really played out very well. But now I think the incremental trade on the short side is the automotive sector. And so I'm all in with you, Ben, on shorting Carvana here. And it's funny because Nadine said, "Well, don't you want to short AutoZone because it doesn't have a big short interest, whereas Carvana has a 10% short interest."
No,
I said, "No, if you look at, yeah, I mean, I think the
you
Carvana, the
want
way
to.
it's acted going in."
Yeah, historically, the empirical record is you want to short the stuff that has short interest. I mean, it means that people want to short it for a reason. You know what I mean? People get scared of that because they just don't, they can't handle the little whips and the short squeezes. But the reality is the market's telling you what. Look, there's a lot of smart guys in the market, right? Like people did the math, and you want to be short what's shorted. The problem is it's just a harder trade to run because it's a little more volatile. You can get a short squeeze, and then also the cost of borrow can change on you, which is it does make it an inferior trade to being long by definition. But I don't know. I never think of short interest as a reason to not short a stock unless it's extreme, right? If it's above 50%, 40%, then you're kind of it gets a little bit dicey up there, but like 10%, I don't think should scare you away.
Yeah, and the other
Oh, you
thing,
know what
Ben,
else?
to me, the
Go ahead.
ultimate
Go
thing
ahead. Sorry.
here with Carvana is the ultimate thing with Carvana, and the reason you want to be shorted is they're showing renewed deterioration in credit on their in terms of their delinquencies. And I showed that chart last week. It had been going sideways for a number of quarters. In the last couple of quarters, you started to see renewed credit deterioration. If that continues, and I think from all signs it will, then they start to lose some of their funding capacity in the securitization market, and that's usually where companies get into trouble when they can't access liquidity. And I think Carvana is sort of on the cusp of losing that access to liquidity.
Yeah, I can give you an example of that. A buddy of mine used to work at a big private equity shop, and they owned America's Car Mart, one of these subprime, lender dealerships in the South. And in February 23, they just lost their line, their securitization line, and they thought business was going well, and then boom, they were gone. Like business was in Chapter 7, like that. So those securitization lines are basically like the lifeblood of that business model. So I think Charlie's right there, that's what's really important. And the last thing I'd say is, if you looked at the GDP report today, which was stronger than expected, the durables actually missed. The durables are minus 2.2% versus expected of minus 1.2, 1.3, and that kind of goes in with what Charlie's saying. The bigger ticket, the bigger the autos, the trucks, the heavy equipment were still very weak. So I think that's it. You guys got anything else today?
Not today.
All right.
Not for me.
Well, that's great. Well, Merry Christmas from us at Wall Street Beats. I'm Benjamin Bry. That is Bob Morris and my buddy Charlie Peabody with a great hat on today. We will catch you soon, and have happy holidays.
Thanks, Ben. Thanks, Bob. Thanks, Jen.
Yep, thanks.